Hello everyone, and welcome to the Dashcast, where we go about trying to find the most interesting people in the world of cryptocurrencies, finance, and business. On this episode of the podcast, we're going to get a solid institutional perspective on the crypto space from an individual known as Daniel Wolfe. Daniel is the co-founder of the Simoleon Long-Term Fund, a fund which helps to play a role in managing over $750 million of investments. He's had years of experience in traditional finance, working at respectable investment banks such as Renaissance Capital, and now he's taking his expertise to the crypto space in the world of algorithms. Our sponsor for this episode is MoonTech 2018, the largest conference in Northern Europe devoted to blockchain technology and its implementation in various industries, which will be hosted in Tallinn, Estonia from the 26th to the 27th of November. Unlike a lot of recent blockchain conferences that are focused on advertising ICO projects, MoonTech's focus lies in the technological part and solutions that can be brought to life, which consequently may change the direction of many industries, including the public sector, fintech, insurance, cybersecurity, logistics, commerce, and more. Click on the link below the video to check out the conference site and purchase tickets to the event if you can make it. I look forward to meeting you all there as a speaker. What's going on, everyone? My name is Nicholas Merton here at Data Dash, and today on the Dashcast, we have a very interesting guest on the podcast. Today we have Daniel Wolfe, who is the CEO and co-founder of Trading Gene, and as someone who has a lot of experience working from a traditional financial perspective, both in the traditional financial space and investment banking, but also in the institutional space for cryptocurrencies, running a variety of different crypto hedge funds. He's going to be giving us a lot of interesting perspective, not only on what the space looks like to an institutional investor at the moment, but along with that as well, talking about how big of a role algorithms play in the crypto space as well as traditional finance. So, David, thanks for coming on to the podcast. Really appreciate it.
Thanks, Nicholas.
So to give a little bit of background as to kind of how we wanted to have David come onto the podcast, David and I met back, I think we met back last in Singapore.
Daniel. Your dad always called
Does he call you David? That's probably why. Sorry. Yeah.
A lot of people do. It's a weird thing. I don't know why.
Yeah, sorry about that, Dan. I mean, basically, when we met back last...
That's when you started.
So we met back in Singapore when we were speaking at the Blockchain Economic Forum, and we were on a panel for altcoins versus Bitcoin. And I remember we even had Tone Vays on there, and he was kind of rambling on, as a Bitcoin maximalist, and saying all altcoins are scams, all ICOs are scams. And we had a really good time on the panel.
There's only one blockchain. It's the Bitcoin blockchain. There's only one coin. It's the Bitcoin.
Yeah, I think you brought a really interesting perspective to that before we dive into the bigger topics, and it was that, coming from that kind of investment management perspective, you never put all your eggs in one basket, right? And this is, I think this is something that I think all of us in the crypto space who kind of come from that investment perspective understand, is that you might like Bitcoin, it might be the strongest, most secure blockchain, but it's not always good to bet on one thing. It's just as it is, not to just bet on commodities, all in on crypto, or simply on equities. So it's good to diversify.
Yeah, the basic rule of investment, no matter what the asset class, is always diversify. And I started my career back in the '90s in Russia when the emerging markets as an asset class were being born, and especially Russian equities. And people always get very excited. There's always so much emotion when an asset class is being born, but they sometimes leave behind what are pretty solid wisdom for investing that starts with diversify your risk.
Yeah, I want to ask you as well, you're based out of Moscow at the moment, last time we checked, and along with that as well, I wanted to kind of ask you, seeing as you brought up emerging markets, this has been something that we've been talking about for a while, and I had mentioned to you is kind of catching my eye right now in the crypto space. You notice there's been a lot of recent turmoil in emerging markets as of recent. We've seen this in countries experiencing currency crises, geopolitical issues, all types of different things, and it's kind of created the perfect storm at the moment. So I'd love to get a little bit of perspective before we dive more into the institutional side of crypto and algorithms. What are you kind of looking at in regards to emerging markets?
Well, I think it's a very important part of trying to understand what blockchain and what cryptocurrency are going to do in the world. And I think, especially for people who are in North America and Europe, they can sometimes lose sight of the fact that for almost all the people on our wonderful little planet, there's no reason to trust your local currency. Mm-hmm. There's almost no reason for you to have faith, because like if you're in Argentina, right, you've devalued 4 times in the last 25 years. Russians, over the last 25 years have 3 times lost all of their money in currency reforms, Venezuela. So the idea of having a decentralized currency that has natural inflationary or even deflationary characteristics, but is not subject to the whims of poor macroeconomic management or bad central bank, is really very powerful. Moreover, there's a lot of other things happening in emerging markets that are quite interesting. I always think about the fact that almost 2.5 billion people in the world have no bank account. Mm-hmm. They have no credit card. They don't have anything. But Credit Suisse did a really interesting report a few months ago where they said 90% of these people have phones. Mm-hmm. I think for most of those people, they're going to leapfrog right past the traditional banking system right into blockchain-based and other decentralized currencies, because this kind of thing happens all the time. When Russia became free, in 1992, they had very low fixed line penetration. Mm-hmm. And they still have very low fixed line penetration. Nobody has a phone anymore because cell phones appeared before they could introduce the fixed lines. And I think the same thing is going to happen here. With all of the sanctions that are happening too, the U.S. is sanctioning many Russians, Iran is under sanction, they threaten China with sanctions. These are really powerful arguments, again, for people to sort of focus on alternatives to the dollar. And all of these things, I think, sort of accelerate the case for cryptocurrencies, adoption in the future.
Yeah. One thing that I brought up, and this is what I keep talking about when I look at countries like Venezuela, and you said even larger countries that fit into emerging markets like China and in Russia, for example, that we're seeing this dramatic shift, and it's a step in evolution of money. So, like, for example, we're used to the West being the leader in technology, right? The development of technology, the adoption of it, smartphones, for example, probably one of the most recent ones for the U.S., and then it comes towards China and the eastern part of the world. But what I find fascinating is that I think this is going to be the first major technological innovation in a long period of history that isn't going to come from the West first. It's going to start in the eastern part of the world, in emerging markets. And it's going to be fascinating to see that. And we'll be kind of like the last people on the door on the way out if the dollar sees any type of volatility or loss of, respect or trust. And I think that's going to be a really interesting shift to see that all these countries that have been wronged by either central banks or failed leaders or failed governance models are going to actually be the first ones adopting it. So it's pretty exciting in that regard.
And as long as we're on the topic, there's 2 really powerful things that are starting to happen and that the blockchain and Bitcoin are going to accelerate. Mm-hmm. One is that most people in the world have almost no ability to invest in assets that are outside of their own country. Many of them don't even invest inside, but the Chinese have no access to the S&P 500 or European stocks. And it's even worse if you go to India or Indonesia or Africa, Latin America. And I think that the blockchain is going to give them the opportunity. People will start starting income-producing property in hard currency places like Europe and the United States, and allowing anybody who wants to get a little piece of that monthly income. And the second thing that's happened, which is sort of paused now with the pause in ICOs, but which is really fascinating, is the ability of people who recently had to go to New York or London or Tel Aviv or Silicon Valley or Shanghai in order to attract capital to their entrepreneurial projects. And now this whole universe of entrepreneurs, they could be sitting in, Central Africa, and if they have a good idea and the ability to create a beta and a white paper, they can attract financing from it. And I think that's going to be completely transforming, and it's another reason why I think you're right. The adoption in emerging markets is going to be much faster than it is in the West.
Yeah, I agree. To your first point about restrictions on investment, it really pains me to see that in the U.S., for example, I can invest in companies like Alibaba, but again, like you said, in China, there's such restrictions not only on equities and the opportunity to invest, for example, in things that might be dealing with venture capital, or maybe, for example, if you don't have enough to invest in properties, being able to fracture the investment property and break it up so people can buy smaller chunks of it and do partial investing. I think that needs to come. But along with that, like when we were talking about emerging markets in countries like Venezuela, they have capital controls. They can't switch to a stable currency like the dollar just to escape what's going on in their country. Right. Yeah, so it goes both ways. It's all over the place. There's this totalitarian government approach to restricting financial opportunity. And I think, again, blockchain and crypto fits into that gap, and it can't be stopped because, again, it's off the grid, it's decentralized, trustless. And then, right. And towards your point as well about the kind of center of tech, again, it used to really just be Silicon Valley, probably a few hotspots in China like Shenzhen. I mean, you have some hotspots around the world that really define the technical side of development for applications and software. But now you can see it, I think you're going to see a variety of blockchain hubs in India and what we're seeing in Singapore. So it's really, really fascinating to see how
There's tons of blockchain stuff happening here in Moscow as well. Mm-hmm. Absolutely.
Oh, yeah. No, I think they were one of the largest. I read an article. I think Moscow was the largest hub for ICOs out of the entire crypto space. I think there was a Bloomberg article on that. So you're in the right spot. I appreciate that. But going on here, I definitely want to dive into kind of getting your perspective, Daniel, because you do come from that investment side, and I think you had some really good things to say on the panel back in February. But I'd love to get an opinion on your current state of the markets right now, because many of us who watch the channel, and myself included, I've done well in crypto markets, but we're retail investors. We'd love to hear what kind of the bigger money is feeling in regards to crypto. Sure. And yeah, where you stand.
So I think there's a lot of different things happening in cryptocurrency. I think there's still the biggest portion of the institutional investors who are basically now saying, this is not going to happen. It's a bubble. It's just for money launderers and drug kingpins and all that stuff. And I think it's always good to ignore that. One of the things that I found in the traditional financial markets, and especially institutional investors, is they always talk their own book. So until they are long cryptocurrency, they're going to poo-poo it because they want you to go into other things that they're actually selling. I think that said, people are more and more interested. One of the things that I do as a complement to what I do in my, for the fund that I have and the Trading Gene is I give lectures to institutions. Mm-hmm. I go and talk to them about blockchain. So, it doesn't matter if they're PR companies or banks or industrial companies, because people are starting to be interested. I see, I went to the biggest PR company in Russia called Mikhailov and Partners. I know the managing partner, and I was talking about what I was doing. She says, that's super interesting. Everybody in our office is interesting. I said, if you're interested, I'll come by, for lunch next week, and I'll give you a lecture. And they had 85 people there. They were standing room only. And I said to my friend, I said, Ellen, do you always have this many people? She says, no, usually we have like 6 people. The interest is really there.
Wow.
For the institutions, the adoption is really, there's 2 huge problems that they have right now. And both of them, I think, will be solved in the next 18 months. The first problem they have is there's really no infrastructure for them. Mm. So, for instance, even in our fund, for us to work with many exchanges, we have big problems because we're not going to work with an exchange unless there's somebody I can call up if I have a problem. And many exchanges can't deal with that. We also want to have internal approvals like multi-signature. We want to have auditors who have viewing rights, things that are fairly standard in almost all in financial markets. And here, the exchanges, which were set up mostly to serve individuals, can't do that. So as their institutional offerings start coming out and it becomes possible for them to get in, they'll get in.
Yeah.
And the second thing, which is even more important, is you do have real challenges in most established markets in terms of the legal framework. Not just in terms of is it legal or is it not legal, because I think that's really not so interesting. Mm-hmm. But if you're a large corporation, you need to have absolute certainty that you know how to put a Bitcoin or Ethereum or Ripple or Lumen, whatever you want to put on your balance sheet, that you can put it on your balance sheet. And not only do you want to put it on your balance sheet, but you want to understand for tax purposes, is this a currency? Is it a good? Is it a security? And whenever they try to make a decision, they need to have their lawyers sign off on it. They need to have their accountants sign off on it. They need to have their bookkeeper sign off on it. So there are these challenges that make it hard for people to get in. But as as soon as there's one relatively normal jurisdiction that solves all of these problems, maybe it'll be Malta, maybe it'll be Zug in Switzerland, maybe it'll be Singapore, maybe it'll be Japan, maybe it'll be Russia, who have a draft of a cryptocurrency law that's going through the parliament right now. As soon as you have a place where international investors can go there, open a bank account, and put something on their balance sheet, that's going to happen. So I think it's going to happen faster than you think. And I don't confuse the rhetoric that this is not interesting that they always say with the reality. As soon as they can invest, they will.
Yeah, I'd heard, for example, that there's talks and rumors that banks are going through, and obviously not only setting up trading desks, this has been relatively public knowledge with banks like Goldman Sachs, but there has been talks that these banks are going through and trying to establish, actual trading teams that are going to be trading cryptocurrencies. They're getting trained right now to actually be prepared for this. But I completely agree with you, Daniel. In regards to the two issues that I really see, and I've had experiences myself when I've tried to use cryptocurrency exchanges, the struggle it takes sometimes to get my KYC verification done. And the fact that I can't, if I'm having an issue with withdrawing money or depositing, and I can't get someone on the phone, that's the amount of money that they're making and that they can't provide that is really shocking. I mean, I experienced it mostly with Coinbase and a few other secondary exchanges when I just wanted to trade one cryptocurrency. So I couldn't even understand or fathom what that would be like if you're trying to place a multi-million-dollar order or something like that over OTC markets or over an order book exchange. I mean, that's really, really nerve-wracking. Not to mention, I think as well, I was trying to go through and do my taxes last year, and I used Bitcoin Tax. I used systems that help simplify it, but it's still so up in the air. You don't know if you're paying the exact right amount of tax. Is Lumen, you're mentioning Stellar Lumens earlier, are Lumens different than Bitcoin legally? Like, are some of these ICOs, are they securities? Do I have to file these as capital gains or, but anyways, I completely agree. I think there needs to be more of a legal framework, and there also needs to be a few of these hopeful hubs in the next few months that are going to provide the legal framework, provide the custodial support and the customer support as well to really make this more efficient.
Custodial stuff is critical. It's really critical because, for our fund, we had to set up all of our own cold storage. And, as paranoid as people can get about trying to make sure that nobody steals their investments in cryptocurrencies and tokens, as soon as you take other people's money, your level of responsibility goes way up. And so, the custody stuff is really, it's a real challenge, I think, for institutions. And I think, the good news for the people who are out there now is once that happens, it's going to happen really fast. And there'll be a massive revaluation of the market. Mm-hmm. It'll be impossible to catch that. It's going to happen. It's going to be all of a sudden like it happened yesterday. You wouldn't like tomorrow. What's going to happen tomorrow? And then you'd be like, oh my gosh, I missed it.
Yeah, the huge green candle of Bitcoin going up, right?
Yeah, it could happen.
Yeah, no, I agree. I think that we saw, for example, people don't think how big the custodial issue is, and I think what I always jump back to is the picture I remember seeing in the media of Coincheck, the Japanese exchange, and the CEO just sitting there at the table, like just pale-faced, absolutely in despair because they just lost $500 million worth of one cryptocurrency. I mean, that happening to a traditional institution and having to cover those losses is massive ramifications. And I think that's what scares a lot of the institutions who don't know anything yet about a cryptocurrency or are still wondering, hey, can we store this properly, from at least even touching the space or establishing trading desks.
And the way it'll happen is somebody will set up a institutional bulletproof custody, and they'll go out and get one of the larger insurers, whether it's private underwriter at Lloyd's or Zurich Re or any of the big multinational insurers, and they'll say you don't have to worry. If somebody steals your Bitcoin, this big insurance company will pay the amount, and that's when it'll happen. But,
so in that case, they would establish, and if I get this right, kind of like custom insurance policies for cryptocurrency exchanges. They would negotiate the rates, etc.
Yeah, well, it'll start first with the custodian. So the custodian will say, we have an insurance policy up to $10 million from major insurance company, AAA rated, and if there's ever a problem with things that you have put on in our custody, they'll make you whole.
Okay, cool. That's awesome. I mean, yeah, I completely agree with you. I think these are some of the major things that, again, we need to understand if we want to see ETFs, if we want to see more institutional adoption on both the hedge fund side and family fund side, which we are seeing there's plenty of right now, but there's going to be even more down the road once we fix the custodial issue. I think that's going to be a huge play. But
one thing people should always think about too is that institutions also have FOMO.
Yes.
So as soon as anybody, and it doesn't matter whether it's a commercial bank or an investment bank, as soon as anybody makes real impact on their quarterly statements because of a project that they're doing in cryptocurrency or because of an investment that they made, they're all going to come in. They hate being behind their competitors. So, FOMO is not just something that we have. Institutions have it even more.
Yeah, exactly. I think finance, people always see finance as just simply banks, but the financial sector is separate into a variety of different sectors. And a lot of it has to do with gathering trading revenues. Again, whether banks love crypto or not, or don't want to see people using peer-to-peer digital currency, there's a market to trade there. It's a speculative market right now. And to step away from that, when I think, for example, I think it was the same week, Jamie Dimon came out and he was, talking bad about Bitcoin and calling it a fraud. Literally a week before, after JP Morgan came out with their quarterly results and stated that by next quarter, they're expecting trading revenues to drop 30%. Why is that? Because of cryptocurrencies and the fact that equities markets are getting overextended, less volatile, and traders move elsewhere. So there's a market for it, I think. But
and then a couple of months later, they put out a 72-page report for their private high net worth clients saying you should be in cryptocurrencies and pay attention to
really? That's incredible.
I'll send it to you. It's actually a pretty good report.
I'd love to read through it. Yeah.
Yeah, it's actually really quite interesting. One other thing that we should notice, which is really curious to me, and it'll help the bulge bracket firms get into it. The Goldman Sachs and the Morgan Stanleys and the Merrill Lynches get into crypto. Is most of the big volume trading now is OTC. Mm-hmm. It's all telephone driven. Even guys like DSX and CEX, they're doing mostly over the phone trading, and for the traditional institutions, and even for me, from an emerging market brokerage, this is a very comfortable way to work. So, not having to go to a DEX and not having to figure all this out, but being able to just get on the phone and say, I want to buy 25,000 Bitcoin. Can you make me a market? And having somebody call them back, it's going to make it easier. It's weird that it's going that way because it seems kind of like a step towards the old world and not towards the digitally intermediated world that we thought we'd be going to. But again, I think it's a good thing.
I think, honestly, I don't think there's any problem with institutions doing OTC. Some people say it steals liquidity from the traditional order books, like of exchanges that we use as retail investors. But those will grow over time as markets grow, as more retail investors get in, as more kind of mid-tier institutions get in. But I think more than anything, OTC is just a way of trading. In fact, it's actually very similar to how crypto would be seen as trading because it's simply matching together off exchange. Yeah. So, I mean, now there is a middleman in between, but that's necessary. I think people always want to have a person on the line when they're doing, like you said, a 25,000 Bitcoin order. And there's tons of that going on right now. You have, I met actually one of the guys who's headed over at DRW Cumberland. They're the largest crypto OTC fund. Yeah. Awesome team. I remember I've been talking to some of the head guys over there, and I've also gotten to meet people who kind of work in the off-grid OTC space, kind of the gray area where there's tons of transactions going on, sometimes even bigger, simply because people are looking for privacy. But obviously, I've just been fascinated by that over the past few months, but it'll continue to grow. I don't think it's going to go away as institutions get in. Yeah. But anyways, so I want to ask you a little bit, David, now, because I've been trying to get someone onto not only the podcast, but also just on the channel to talk about algorithms. I think so many of us in the crypto space who have tried day trading feel the pain of losing because we've come to realize, wait a minute, I'm not trading against humans. I'm trading against algorithms. I'm trading against something that knows exactly what I'm going to do, or at least can get a very good guess as to what I'm going to do. So I'd love to kind of get your perspective. I try to explain to people from traditional markets just how important they've become, but how quick they're moving into crypto as well. So yeah, I'd love to hear kind of your perspective working in the space.
I mean, algorithms. If you start at the very top of the food chain and you look at the largest hedge funds in the world, Bridgewater, Two Sigma, Citadel, they are almost entirely algorithm driven, even in traditional markets. And there's a whole bunch of reasons for that, and not many people think it has to do with high frequency trading, but it's really something more basic, and that is that algorithms solve all kinds of problems that humans have as traders. The biggest one is that they're not emotional. They're incredibly consistent. So for investors who want to have who have a clear strategy and want to just execute it, algorithms are very, very efficient. The problem is, up to now, most of the algorithms that people have been able to get are because they put a room full of, very intelligent data scientists into a room and some economists, and they say, here's an idea for a strategy, and they work on it and they test it. So most of even the smaller hedge funds and the family offices are priced out of this market. Mm-hmm. And that's what we're trying to attack with Trading Gene. But especially in crypto, there's a couple of reasons why the market is so open to algorithmic decisions. The first thing is that the markets trade 24/7. Mm-hmm. So even if you're a good trader and you're making good trades and you're spending 12 hours a day, every single day, sitting in front of your computer, unless you zero out your position at the end of that, go to sleep, go have dinner with your family or whatever you want to do, you can get killed in 5 minutes while you're not looking at your screen. So algorithms have the advantage of not going to sleep. And the power of the algorithms also in crypto markets is that the crypto markets continue to be pretty inefficient. Mm-hmm. So that pretty simple trend following algorithms that just try to catch the big ups and avoid the big downs can do extremely well in cryptocurrency. In traditional markets where you have much more volume and a lot more investors and more algorithms, any kind of movement away from the true value or the mean just gets dragged right back very fast. So your algorithms have to be fast. You have to have infrastructure. But the crypto markets, at least for now, are so inefficient that algorithms work really, really well.
Interesting.
And so one of the other things that's really interesting is there have been all these studies about day trading and people who are active traders. The biggest one was in 2011, where they got all this data from all the big North American trading platforms, from E-Trade and Charles Schwab and Ameritrade. And these Harvard professors decided, after analyzing the data, that less than 2% of the traders make money every year.
Yeah.
90% are just giving money to brokerages. So that's the second reason why it makes sense to start looking for solutions that are algorithms.
Yeah.
So what we do is we got into the algorithm business in 2015 when my partner was trading futures on traditional markets, oil futures, stock market futures, bond futures. And he has a commercial real estate business. So he's always driving around, and he started trading because he was in the car. And he's like, I don't want to waste the time in the car. I get sick if I read. So he started day trading, and he did really well. And then he got frustrated because he said, I don't really understand. I have this great strategy that works. And when I get out of the car to go to a meeting, it stops working. So he set up this platform, invited a whole bunch of algorithm creators to come on the platform to help him get algorithms that he could make money with. And then he decided, well, actually, I could sell these algorithms to anybody, and I could let anybody who wants to make an algorithm make one. So, we now have a marketplace that's up that you can go and hook onto an algorithm and have it trade on your account, and you only pay a success fee if it makes money.
Interesting. Yeah, I want to go back.
Our algorithms are they're grossing about 10% a month.
Wow.
Right now. But because of the high commissions, it's about, you only net about 5%. But as our volumes go up, we're talking to all these exchanges. We're going to bring the things, and these are algorithms that trade only about once a day. Okay. We have algorithms that would trade 30 or 50 or 100 times a day, but we're not using them because the fees will kill you.
Yeah, exactly. You can only do that on something like traditional markets. If you had something like interactive brokers where fees are dropped dramatically, or commissions on trades, and not to mention they have platforms, not only platforms but also programs that you can register and pay a monthly fee, and that's your one-time fee, so you don't have to pay any more, and you can trade as much as you want on the platform. Yeah. But to the point you were making up earlier, I want to bring up another addition to what you said. I always try to tell people that figure has always been around the same ballpark. It's around, some people say 90%, 95%, and in this case 98%. I know the study you're referring to by Harvard, and I think it's not only a good lesson to realize that only 2% of traders will on average make money in traditional markets, but along with that as well, that even for those 2% who make money, we have to ask the question, wouldn't they have done better just simply long-term investing, or like you said, going towards an algorithm? And that's my big point, is I try to tell people in crypto there's a slightly higher success rate, because if you were trading back in 2017, everyone's a genius because the market's going up. But the thing about it is that you always have to assess. The best thing I always say is, when you jump into trading, if you really want to explore it and start trading off TA, the best thing to do is to have what you would have invested long-term on the side and see if you can beat out your long-term portfolio where you would have had to do nothing.
That's very smart.
Yeah. So anyways, I completely agree with you. I think that we underestimate how big algorithms have become. I know that I remember in the first few months of getting really active in crypto, I'm like, oh, please, they don't have algorithms just yet dominating crypto markets. And they do. That once we've gotten the liquidity now that we have, they can actually trade in these markets, and they can take away from those inefficiencies, like you mentioned, whether it's through arbitrage, whether it's through, trading off of hype or speculation. There's all types of different ways in this market that they can trade. So I'm curious to, hear a little bit.
On the arbitrage side, it's another interesting thing. So, in addition to trading, Gene, I have this fund called Simoleon Long-Term Value, and we started working with one of the major exchanges to try to see whether arbitrage, which is a totally different kind of, it's also algo driven, but it's basically, the idea, in case people don't know, is that, you find a single asset that has two different prices, and you sell it in one place and you buy it in the other, and you make the difference. So we've started experimenting with arbitrage, and if it works, we may set up a fund. But it's still very, very hard. The window's closed even in crypto pretty quickly. But I'm worried more about the fact that there's not a lot of volume on these exchanges. So, you sometimes see it, but there's not enough volume because they can't sell you enough for it to be worth your while. And the other thing that is important for people to understand, no matter what they're doing, even if they're just buying and holding, is we are in markets that have enormous amounts of manipulation going on. There's price manipulation going on. There's volume manipulation going on. There's all kinds of things going on. So people need to be especially careful, because even in markets where there's little manipulation, you can get your head handed to you. But here, because of the manipulation, it's worth being especially careful.
Yeah, I think when you're talking about manipulation, I love cryptocurrencies, but as critical as I am of traditional finance, sometimes I'm not going to be, opposed to treating crypto markets the same way. I think it's only fair. I mean, there is clear signs that at the moment there has been wash trading going on in exchanges, that there has been massive amounts of wash trading. That's probably the biggest right now, because exchanges want to have the highest amount of volume for people on the retail side going to CoinMarketCap. And CoinMarketCap delists some of them that have obviously fake levels. You have wash trading, you've got spoofing on the order book where people place fake orders that never are meant to get executed and will never be executed because they click off the order book before a buy order can come in to actually buy the sell order. And there, along with that as well, there was a big issue.
There are a lot of tokens inflating their own turnover because they want to get up also on the first page of CoinMarketCap. I mean, it's
exactly. No, I mean, there's not only there's a lot of wash trading and most of the trading volumes either that or market making, which market making isn't, I wouldn't say technically manipulation, but it gives a false perception sometimes. And the other thing as well is that there was a big issue in China. A lot of these exchanges that are proposing large amounts of volume, they're doing it because they're creating exchange tokens where they have a trading fee or mining fee mechanism where basically, if you hold this token, you get a certain amount of the fees. And look at all this volume, you're going to be a millionaire next week. So everyone was selling to be the next Binance. And I think there was like a dozen of them coming out each week back about a month or two ago. It was such a big issue. They were pretty much just pumping pumping and dumping the tokens. So yeah, no, that's the thing is I think this is the kind of stuff that scares away institutions. And as much as I know people are anti-SEC and anti kind of the traditional world, I have my negative things to say about it as well. There is decent room for regulation. There's decent room for skepticism of the space because, again, I think this is something you were mentioning, a Harvard study earlier. There's another one I really liked that it was like, I think 10% of all people in the financial world, it was founded by, I think, a Harvard business study, are psychopaths. They're defined as psychopaths, which is comparative to 1 to 2% of the human population in the world. So finance brings those kinds of people sometimes, especially to the upper echelon. Yeah. So hopefully we're not psychopaths. Let's hope that's not the case. But
and one of the things that's also to be said in the defense of crypto markets is anybody who's had the good fortune of reading Michael Lewis's book Flash Boys, gets to see that there's all kinds of completely legal institutional manipulation of markets that makes tons of money for big financial players to the detriment of the market and individual investors. And it's going on. Michael Lewis wrote a book about it. It's a best-selling book, and guess what? It didn't change anything. The SEC allows these HFT guys to jump bids. Essentially they put their server on top of the server of the New York Stock Exchange or one of the other major exchanges or electronic exchanges like Island, and they see an order come in for Coca-Cola, and because they have super high fast connections to all of the exchanges, they hit all of the exchanges at 1/100 of a cent below that, and they kill the order.
Yep.
And then they do a bigger thing at like 0.3 of a cent below that, and they're just making 1/10 of a cent or 0.1% or 0.15, and they're doing this over and over again. And as a result, instead of a buyer who wants to just fill in order getting his order at that price, they're paying more.
Yeah.
So
I've actually got to read Flash Boys. I'd watched so many documentaries on hyperfrequency, but I mean, it is amazing how that stuff still goes on a daily basis. It's a massive market, and it's basically playing off the inefficiencies of sending, the time it takes to send a transaction to the actual exchange. And yeah, I mean, there's I can't remember what I was going to bring up, but there was a video. There's a video I can leave to explain it down in the description. So I'll try to remember to leave that there for you guys who want to learn more about it. But yeah, I mean, it's fascinating. Like Daniel was bringing up, there is a really big issue in the fact that you can just do this. You can run these algorithms, these hyperfrequency trading algorithms, and you just kick back and relax. They're pennies that they're making, but they pile up very quick. Yeah. So
and one of the other things about algorithms, which I think is important to point out, I would say there's two really important things. One is that, we are, I couldn't get through the day without algorithms, right? Anytime that you want to look up information and you use any search engine, that's an algorithm that's finding the information for you. If you ever turn on the map on your phone and it tells you how to go, that's an algorithm telling you how to go. I used to listen to music. I used to read Rolling Stone. I'd go to record stores. I'd buy a record. I'd listen to it over and over again, decide what I like. Now I let Spotify. Spotify says, I have a new bunch of songs for you this week. And I say, okay, it's fine. I'll listen to that. So algorithms are now playing music for me. And, so the idea that algorithms, which have dominated so much of our lives and are yet sort of outside of our financial lives, I think is kind of strange, and so it makes sense that they're going to come. But the second thing I'll say, and we have this problem with when we sell algorithms to people, is that people think they're magical, right? So somebody will hook up an algorithm to their all the trading takes place on their own accounts. They don't actually send us money. So they'll hook up an algorithm onto their account, and 2 days in they'll call me up and they'll say, Dan, I didn't make any money yet. And I go, we hooked this thing up 24 hours ago. And they go, well, when am I going to make money? And I said, well, let's talk in 30 days. Let's see what happens. And so the idea, people need to forget about the idea that, there is some magic to this. It's really just a different way of dealing with it. Another way to think about it is ETFs, which are estimated to be around 23% of the American market. That's just a dumb algorithm, right? That's an algorithm that says, give me $100 and I'll make you $100 that looks like the S&P index, or that looks like this universe of whiskey stocks, or that looks like this universe of oil companies. But I say it's a dumb algorithm because it's basically a static algorithm. It's not trying to determine any information outside of what's the percentage of stocks in an index.
It's not asking, what's the best stocks within the S&P 500 and learning from past mistakes and improving over time. It's just static, saying, follow what it would be if I'm holding a chunk of the S&P 500, or, if I'm holding, oil futures or a variety of tech stocks in a specific sector like semiconductors or solar panels or something like that. Yeah.
Right. And it's not saying what happens when a company, has its capital investment program fall in half. Mm-hmm. How many quarters before their stock gets impacted? What happens if they have a bad quarter? How long does that impact their stock? There's all kinds of data out there. It's more data than even for crypto. And so the algorithms can study it. And for trend following algorithms, really what they're just looking for is the candles and the patterns that allow them to understand that there's going to be a big move and to catch that big move. Mm-hmm. So, for instance, it's very interesting if you look at a trend following algorithm. Most of them have 5 or 6 losing trades, and then a 7th good one.
Yeah.
And if you aggregate those trades over a couple of months, you end up with really outsized returns if the market's going up. And if it's going down, you end up with positive returns when everybody else is losing money. But again, one of the things that you have to understand is that the algorithm is making these little trades. It's part of it's an analytical process.
Yeah.
And going forward, what I think we'll end up seeing is really interesting things, which is algorithms of algorithms. So, for example, we have algorithms. We have to test all these algorithms. 98% of the algorithms that our 300 creators put online are garbage. We won't sell them, right? So we have a way to check them with AI. But we also, as we check them, we can analyze them. And so we have some algorithms, for example, that work really well when the market's downticking, but not well when it's flat or going up. But we have other algorithms that work well on an uptick and others that are good on a sideways market. So you can imagine taking an algorithm and saying, just look at the market, and if it downticks, turn on algorithm C. And as soon as it goes up from there, turn on algorithm B. If it goes back down, go C. If it goes up, A. And you could imagine like an algorithm that's really 3 algorithms. So we sort of envision in the future having people not only make algorithms that are looking at a single pair of assets like Bitcoin, Ethereum, or EOS dollar, or ES Tether, or whatever, but also that are a portfolio of different algorithms, and people will hook them all up to their accounts, much in the same way that, as we were talking about diversification before, I have a dozen mutual funds and 30 stocks in my retirement account. You can imagine that there'll be a little piece of that account that will have, there'll definitely be some stock, there'll definitely be some cryptocurrency, there'll definitely be some mutual funds, but there'll also be algorithms that are working for me.
Yeah. So in that case, what you're saying is it's kind of like a train of different algorithms going from one to one, inevitably off of market sentiment or price action or certain news pieces. It's really fascinating to think about that. When you get to the algorithms of the algorithms, it's kind of an inception in a sense. It just keeps going down the loophole. Algorithms becoming a bigger part of trading and investing.
If you're using Python, which is one of the languages on our platform, then you can create AI algorithms, which are learning algorithms, right? So ultimately, you'll have, I'm certain you'll have very smart algorithms that are not programmed by a person per se, but that use machine learning to understand markets and then make good trades on those markets.
Yeah.
Right? And it's, there's all kinds of things. I'm certain that if you, for the most liquid instruments on the crypto markets or regular markets, you could create an algorithm that would make money if it learned how to read Twitter, for example.
Yeah, no, I had. There was a funny story. People were building bots off of John McAfee's tweets. Actually, it was just a reaction. It was a very simple reactionary bot. Like, if for I would think along the lines it worked like this: if you see a certain coin symbol in his tweet, when he would do his coin of the week tweets, literally you just see the buy orders flailing on the order book on these cryptocurrencies, and the price spikes 50 or 100%. No fundamentals, nothing real, but it's all those algorithms just getting there to the cusp first and buying in and creating this parabolic kind of pump in the price. So yeah, I think it's cool. You can keep algorithms very simple. They can be reactionary ones, but you can also get them very complex. And I was actually, before I started the channel, I was focusing on data analytics, and I was actually migrating over to data science, and I was learning Python. But it's a very, very fascinating thing to work with. You're always tweaking it. You're always learning how to beat the market. So it's a fun thing if people can get interested and actually take the time to learn about it.
But it's super interesting because having run companies with big trading desks and a lot of risk on there, and I was never a trader myself. You realize that emotion actually plays a huge part in losing money on markets. Mm-hmm. I mean, everybody who's active in markets loses money, and anybody who tells you they're not, they're like the guys who tell you they caught a big fish, right? They're lying. But people get attached to positions. They get greedy, they get tired, they get distracted, and so I think the argument for algorithmic trading is really powerful, and it's good. Algorithms are going to soon be driving our cars. They already figure out how much you have to pay for an airplane ticket, so why shouldn't they figure out what you should have in your portfolio?
Yeah, it is going to be interesting. There's a cryptocurrency you probably know of, IOTA, that is based off this whole concept of the machine economy, and it's this idea. It seems very far-fetched, but honestly, if we keep moving the way we are, and we also keep improving in robotics, this could possibly happen where we have entirely some people might define as artificial markets, but when I say artificial, I mean artificial in the sense of technology-driven markets where bots are trading with one another. There's no human interference. Robots of some sort of running under different algorithms are doing business with one another. Like, it's this very, very sci-fi-ish view. But, again, like you said, if things keep moving the way they are, they're already so much a part of our lives at the moment. If they just keep growing into different sectors and becoming more, I think, more apparent in the physical world as they've become in self-driving cars, I think we're going to see just how big this really is.
It's going to be gigantic. I remember I was reading about Siemens, who were saying that if they could, just in Germany, every night from 3 in the morning until 4 in the morning, turn off the freezer in every German, like it was, I can't remember, it's hundreds of millions of euros they would save.
Wow.
Just by, and nothing, it has no effect on the temperature there, right? And all this stuff, and all of this stuff is going to start happening, and it'll be monetizable, mm-hmm. which is because you'll have the blockchain and you'll be able to say, okay, you saved this much electricity, so you can participate in that.
That's awesome. Yeah, I think in the sense of efficiency, in the sense of providing better things, I think algorithms can be very well used for good over anything bad or anything that, I think it generally kind of gets a negative connotation because it's something we don't understand. It's something that seems so distant. Like you said, we're kind of restricted from it unless we really develop them and understand them. But again, I think what you're doing, Daniel, and stuff with like Trading Gene and offering those kind of services where you can get access to it is really going to kind of open up the floodgates for people to get comfortable with this, understand that it's going to be a way of life and that they're all around us.
Yeah, and the flip side of that, what we also want to do is, we want to allow anybody who has the desire, whether they're a trader with a good strategy or a programmer who knows something about trading markets, but to give them the opportunity to put their algorithm up and sell it and make money. Because, they say in the next 15 years, more than half of the working population in the world is going to be, freelancing. Mm-hmm. You're not going to have a job. You're not going to have a monthly income. And so, we see this as sort of fitting into that and letting people come in and you can say, well, you can make algorithms and do that in the same way that, you can now, if you have a presentation that you want to give, you can find somebody in India who will make a beautiful presentation based on your notes and send it back to you for really very little money. It's pretty amazing.
Yeah, I remember when I was really into graphic design growing up, I remember kind of experiencing the gig economy and seeing how that was starting to flourish on websites like Freelancer. And I mean, it's just getting bigger and bigger. I mean, I know from working in this as a startup company in Silicon Valley, it's the same way. If we need a small task done, we reach out to a freelancer. We did that for our blogs and everything. We would get someone to create these really beautiful illustrations, and they did it for a set price, and every time they delivered well. And it's again, distributing things in a sense rather than keeping it in a central company. But yeah, I think it's just going to get bigger and stuff in regards to things like the gig economy, algorithms becoming a part of our life, and being able to develop that for different types of ways that we wouldn't even imagine algorithms could help. So
we wouldn't even.
Yeah. Well, anyways, Daniel, I think we've covered a lot of great things here in the podcast. I appreciate you kind of not only coming onto the podcast, but also giving us a great perspective on what you're doing with Trading Gene, what's going on in the space of algorithms, and also kind of what you feel is big in the institutional space. Is there anything you want to kind of leave off with, some things that have been on your mind, or some things you'd like to share with the audience?
Yeah, I mean, I guess what I would, maybe it's just sort of a question for you, something that you could cover in a future podcast. But in our fund, we spend about 3 hours a week in investment committee. Mm-hmm. And we're trying to do, what we really think, like right now, it seems kind of crazy because there's so much emotion and the markets are so volatile. But, we believe that over time, it should be possible to come up with an analytical framework that lets you value different tokens and cryptocurrencies. And, I would love to hear more from people who are also, believe that this is a worthwhile thing to be doing, because it's really very hard. Even if you just think about sort of fairly obvious questions like, what's better? Is it, do you want to have Ripple or Lumens? What do you think is a better thing? But and to try to figure out what's a meaningful metric, right? And you mentioned before, people tweeting, or Coinbase says they're going to put 5 coins on into their marketplace, and how does that impact the market? But what are the important pieces, or something that I'm spending a lot of time trying to figure out? How are we going to be able to value things? Because when you think about it, as we started in the institutional market, you have this. Everybody knows what a discounted cash flow is. Mm-hmm. And you can look at any company in the world, and because we have metrics like EBITDA, which take away the importance of interest rate and taxes and rules on accounting for depreciation and amortization, and allow you to look at this company and this company and say, well, this company looks like they're doing better than this company.
Yeah.
I think we'll end up with metrics like that in the crypto world, but it also seems like it's far away.
It takes time to be able to not only build formats to quantify data, but to get access to it. Like, there's a lot of noise in the crypto space. It's a lot of, you can see most projects, they move off of some type of announcement or some type of hype, not very fundamental things. And I think so long as we're in that space where you see projects like, I know there's a lot of fans who like it, Tron and stuff, that come up out of nowhere and just go parabolic. There's no way to quantify that. There was no specific piece of data we could have looked at and said, oh, that's going to make this go up. So I think so long as it's sporadic, like you said, Daniel, it's a hard question to answer. But it's going to be, like you said, in traditional markets, we've worked over the years not only to build the data sets that we can access and also the interface to compare it and get an understanding, but along with that as well, being able to just have the time to build up those frameworks to quantify data. I think that's going to be exciting as well. I think that's going to keep institutions away as well until they have that kind of platform. But yeah, I'm interested to see how people quantify it. For me, I try to spot trends in a sense. So I trade more, again, very human. I try to read human emotion in markets more than anything, so long as it's human driven to a decent degree, and try to find what people are evaluating in crypto. I think last year in 2017, it was highly on the protocol side, on the Ethereum side of things, enterprise blockchain adoption, and now I'm starting to notice the real curves of actual adoption, where we might be hitting the S curve of crypto, which is in the peer-to-peer digital currency side in emerging markets. So I think I play off those big trades for me personally, and I try to see what people are evaluating, because people can change their focus very quickly in this space as it's very early.
Yeah, absolutely.
Yeah, but anyways, Daniel,
super.
Yeah, I'd love to have you back on again. I'd love to, we try to get the best people.
I love talking to you. I hope our paths will cross soon, and we can have a conversation in real time, in real space.
Yeah, I'm hoping actually, just to kind of leave a note here, where I'm hoping when I move out of where I am right now, we're gonna actually try to set up an actual studio and hopefully see if we can fly out people into the actual studio to sit one-on-one, because it's difficult to kind of do it digitally like this, but it's the best we've got right now, and it actually worked out quite well.
Where's that going to be in the world? Do you know yet?
No, I've been looking at a few different locations. I've been, for a while I was set on San Francisco, but it's expensive to live there, and yeah, that's the thing. So I'm thinking about doing something that's not traditionally along the west or east coast, but would still be easy to fly to, maybe near an international airport. So yeah, we're looking at a few different locations, but nothing set in stone just yet.
Yeah, I mean, like Miami, Salt Lake are both really nice. LA is pretty nice and easy to get to, and much closer to Asia than you are now. So
yeah, yeah. So hopefully I'll figure out something soon. We'll have to see. But anyways,
well, I'm sure our paths will cross soon.
Yeah.
One other thing, and you don't have to be this part of the podcast, but I've been also thinking about. I'm actually working with this guy in London. I had this idea of creating a conference. Without any ICOs at all, and just trying to focus on people who are managing funds and people who are thinking about investing. And the way the little twist that I had was I wanted to bring in, for each of the panels as a moderator, somebody who's not in crypto at all.
Okay.
Maybe even somebody who's skeptical. So if we're talking about, valuation, to bring in somebody from Bridgewater, right, who are considered the best guys at valuation, and have that person sit there and moderate, but as a skeptic. And I think we might get a different group of people in the room, because they would be thinking, oh, this isn't just like a bunch of people cheerleading about crypto, but it's somebody who I respect from my world sitting there asking the questions. So
I completely agree with that. Just to point out there, Daniel, I mean, when I've stopped going to conferences, and I think you were saying the same, you've kind of gotten burnt out on conferences, because it's always crowded with ICOs. It's always crowded with, I think more than anything, kind of generic discussion sometimes. And it needs to be about really the big topics, the reason why traditional finance needs to see the potential in this market, really getting to the core values. And to have some of those big names up there that I've seen at a few conferences, it's rare, but if you could get that set up where you have a lot of the big names from the traditional financial world who've also migrated to crypto, I think that's going to open up the gateway, build relationships. And if you get one or two people from some of these large companies, I mean, that can completely change the framework of crypto adoption if you can convince 100%. Some higher ups at the companies.
Yeah. And if we do that, we'll get you out to London too. You can moderate a panel too.
Awesome. I appreciate it, Daniel. All right. Awesome. All right.
Well,
thank you for coming on, Daniel. Take care. It's nice talking to you.
Take care. Bye.
Bye. And that's going to be it for this episode of the Dashcast. Thanks so much, everyone, for tuning into this episode. And if you liked it, please leave a thumbs up down below, as well as a comment as to who we should have on the next episode. Again, I want to give a big shout out to Daniel for coming onto the podcast. And I got to say, it was not only a really interesting podcast, but the takeaway that I really got from it was just how fast institutional finance is moving into the blockchain and crypto space. It's very separate from really the narrative we're getting in the mainstream media. And last but not least, again, a shout out to our sponsor, Moontech 2018. Again, guys, I'm not only going to be attending this conference as a speaker, but I'd really love to see you guys make it out, because unlike a lot of conferences out there, they're really trying to step away from all the ICO and promotional material and really focus in on the utility and value behind blockchain and cryptocurrencies, which I think is really going to help us build the core foundation for this ecosystem. So, hope to see you guys there. Again, the link is down below if you want to get tickets, but if you can make it out, I'd love to see you there. But until the next episode, take care, and I'll see you all in the next one.